Welcome everyone to the JCB webinar, Fixed Income Market Outlook, Investing in a Fraction World. For those of you that don't know me, I'm James Biggins and I work at Channel Capital, and today with me I've got Charlie Jamieson, CIO of JCB. Please look at the disclaimer in front of you. We'll just leave that up there for a few seconds. Today's webinar is going to run for about 45 minutes where we're going to be covering a fair bit of data and a bit of content. So please keep your questions coming through the usual Zoom protocol. And with that, we'll kick off. So Charlie, welcome.
Thank you, James.
It's been an interesting year so far. You know, we've been listening to central bankers. We've been watching that they've been watching data and being very data dependent. But, you know, how are you seeing how the potential rate changes may affect portfolio performance, and just sharing your views would be great to hear.
Yeah, so obviously over the course of the year so far, we started with a lot of expectations for interest rate cuts. Central bankers have been telling us they want to cut interest rates. At the end of last year, data momentum was falling, so the market priced a lot. And then we've had this kind of kick up, particularly in US data earlier this year, and a lot of those cuts have been walked back. Our base level has always been for this year that we will likely have a non-stimulatory rate cutting cycle. So what we mean by that is, you know, somewhere between 75 to 125 basis points of rate cuts. And that is to step down and match the victories in realised inflation outcomes. Now, inflation in the US and potentially in Australia is just creeping up a little bit. It's important we keep that in context. We're not going to 8 or 9%, but we're not getting to 2 or 3% where we need to get to. And so we're just a bit stuck with that last mile. And that's certainly pushing interest rate cut expectations back. We do firmly believe that the ECB will start in June. Bank of England, Bank of Canada can be fairly quickly behind them. New Zealand, Australia and the United States probably looking a little bit further behind that. But we have clearly moved to an environment where we have material yield in the world again, be that in cash, which is now absolutely investable, or in fixed income. Obviously, the journey of getting to those yields in fixed income was very painful in 2022. But it's been our expectation that when we had extremely heightened volatilities in those environments with huge uncertainty about inflation profiles and where central bankers would ultimately end, we have much greater certainty about those things now. And so we're seeing fixed income volatility continue to fall, albeit this data dependency that you touched on is pretty meaningful because central bankers haven't run policy like this before. And what I mean by that is that they've generally had models that they look to, they try to move ahead of, with good consideration for the lag effects of their actions. They're trying to read the cycle and deliver the right policy at just the right time when it's required with that lag, meeting the economic outcome of the day. The failure of those models through the COVID period, and, we all remember transitory inflation, and then it absolutely took off. The unusual way that even the best forecasters of inflation are still getting, their estimations wrong in terms of the absolutes when they're predicting what inflation incoming will be. The margin of those errors has reduced a significant amount, but there's still these oddities, because of seasonalities, because of, one-offs, because of geopolitics, because of changing of methodology. We had this at the start of the year with owner's equivalent rent in the United States, where they completely changed the methodology, didn't tell anybody, and of course it spiked higher and caught everybody off guard. But this data dependency is a little bit of a concern because ordinarily in the cycle, as growth is starting to fall, you would see central bankers respond. And so I guess they're looking at things like employment and those types of things. And you would see them respond in expectation that the lag will take time to come to market. And as growth dissipates, clearly the inflationary expectation and impact on lower growth, lower demand would be mitigated. Because we're now waiting for the absolute identification of those prices coming down, there is the danger later on in the year that growth might have already come off a bit too much. And what we don't want is for that momentum, that negative momentum to continue to build through the macroeconomic landscape, because then you're running into a more severe outcome that requires really severe policy to address. So the obvious example here is 2008, where if you leave rates really high for too long, all of a sudden you've got these big problems that require massive moves, be that in fiscal, monetary, liquidity, whatever that is, to address. ideally, in a perfect world, and of course it's not a perfect world by any means, you would probably try to stimulate a little bit now to smooth the cycle so you don't have to massively stimulate, say next year or the year after or whenever that moment might come. We still very much believe in cycles as much as, with the US government spending 6% of GDP in a deficit sense, and both presidential candidates looking like that's going to be a continuum. The cycle is a bit odd, because the private sector isn't actually doing that well, but the government is just in pounding away, borrowing a lot of money. No doubt we'll talk about US Treasury supply in the last few days, which hasn't gone very well. And there is just this continuum of there's just all of this spending, particularly in the US economy. So that's elongating the cycle, no question. Certainly in the US is absolutely global market leader and capital markets number one. So if they're continuing on, most other markets will follow that lead. But certainly, here, and you've only got to go and talk to your friends or family, anecdotally, the economy is slowing very quickly. We're seeing that in other jurisdictions. It's not severe yet, but it's certainly not great. And the expectation is if we stay in these settings, then it probably gets a bit worse. So how quickly that happens, we're already up to 4.1% unemployment. Does that start to slingshot higher? Or is it slow and moderate? Well, that's the source of great debate. So, that'll be the balance of this year.
Okay, great. And then when we think about, portfolio constructions and looking to allocate to the, to bonds, it'd be good to kind of get your thoughts around, clients are talking to us about going, when is the time to do it? And having your thoughts around probably if there's a rate cut already in the system, that might be a little bit too late. So just kind of getting your thoughts on that would be really helpful too.
Yeah, I mean, it's a really tough question to answer with precision because the way things sequence can change the order of the way that these issues will obviously percolate through. If we get geopolitics and, fiscal outcomes and these types of things, they can knock the sequence out and clearly push, our expectations out by, months or quarters. But certainly, broadly around the world, we're very confident that we've finished raising interest rates. Now, the debate will rage on about should we have one more or two more to really crush the economy and kill inflation? Absolutely. You've got to be careful what you wish for. I mean, you might absolutely kill the economy too. And so, or should you be patient and just let, restrictive rates wash through the system? And it does take time and it's not a perfect linear and it will not be, the perfect continuum. And we've seen that, with some frustration in markets like the US and potentially here. So, the time to go, into duration, if you've been deeply underweight, I think the time to lift those allocations is already probably past. We are around 4.5% yields in Australia as we sit here today, cash rate at 4.35. If you look around the world, 10-year bond yields are normally significantly below cash rates. And so Australia's a little bit of an exception with Japan, and obviously Japan's a very big exception. Given that it's been a highly manipulated market for a long time. So arguably, duration is cheap enough. Can it get cheaper? Yeah, of course it can get cheaper. It's as we've seen in the last, few days, lots of supply came to market in a shortened US week, bit of hawkish speak from Federal Reserve, nothing new in any of that, but a market that maybe was a little bit positioned long and it's had a decent clean out for that supply. And now we find ourselves focused on, next sets of first tier data and PCE, which is the critical, inflation number as the Federal Reserve view inflation. That's on Friday. And then, month end and into next week with, more employment data and more growth data. So we'll see how that goes. We think because central banks have stopped moving rates aggressively that we are in a range. And that's not to say that we can't whip around in that range quite quickly, as we've seen in the last, little while, but the range should hold nevertheless. There's no real expectation that we should slingshot to higher rates, nor should we absolutely collapse to lower rates, barring some exogenous shock, which may come. But these charts that we've kind of got up on the screen do illustrate that you don't want to wait too long. There is material income available, notwithstanding the market is still bouncing around a little bit, but it's kind of busy going nowhere. We've been around 4.5%. We've been down to 4.30. We've been up to 4.60. But we remain here in this range. And so I think, it's our expectation that should be, pretty high probability area where we will reside for a little while longer.
Yeah, great. And then on the next slide, we've kind of got and I know you've spoken about this in the past, it's around, picking your own journey. And when you look to duration, we've also got obviously other ways that you can access the bond market. So it might just be, good to kind of think about, while we think duration, there's an appetite there to take that on in a portfolio if you don't have any, but also maybe just touching on what we can do in other spaces around that, absolute return space. And,
Yeah, so Matt, I might ask you to come forward to slide 9.
Yep.
What we've just been talking to investors about is, there are a number of outcomes for different portfolio types. Obviously, we know that things like credit portfolios have done really, really well lately. And as I said, we still believe in cycles. And so, that can continue, absolutely. But it really comes down to, what do you need from fixed income? What is this defensive allocation in your portfolio to do? I always think about it like a sports team. What position do you play in the team? What's your job? We think bonds are supposed to be defensive. They're supposed to provide liquidity. Hopefully, they're negatively correlated. In periods of really high inflation, like 2022, we saw that didn't work. Although the drawdowns were terrible for bonds in terms of what their expected returns are. That's a real one-off, kind of move that is a real big left tail outcome. Are we going to have another one of those? Of course, it's mathematically possible. I can't say that we won't have that. But it is our expectation that with restrictive rates and, rates that have been high in economies for quite some time, the much higher probability, and when we look at our scenario analysis, it is not a perfect normal distribution of scenarios. It's just 5 scenarios. And you can see on the perfect normal distribution, there are obviously a lot more points where people do check in and say 1 standard deviation, 2 standard deviation, 3. If you need the right tail, so let's talk to a year like 2008 where, equities are down 30, 40, bonds are up 20. So you've got that real counter lever in your portfolio, then you must accept that there is a potential left tail as well.
Yep.
And we saw that in 2022. It's unlikely to be repeated. And obviously the income that is now inherent in these allocations is quite prevalent. And so even there on the scenarios, you can see if yields go to 5% from almost exactly where we are today, there's still positive total returns. Now, notwithstanding, you would have done much better to be allocated in cash. And with high cash, it's always hard to argue against that until, these things take off and people say, oh, why didn't I have more of that? I would have enjoyed that journey. And now my resets on cash are clearly coming down fairly quickly. The other thing about cash, obviously, is to maintain liquidity, you generally need to run a whole bunch of cash ladders. And so you lose liquidity to that whole allocation. So our dynamic alpha portfolio, which we're talking to a lot of folks about, we're gaining a lot of traction in the institutional market with this at the moment, is designed to have an RBA cash plus outcome. And so whereas there are obviously a left and a right tail, and we still firmly believe that we're more likely to be in the middle to pushing right, given where we are in the cycle. There's no certainty to that, of course. That's our best estimations on where we are. But what we do have a greater certainty on, and again, we can't predict this, we can't guarantee this because it's illegal as a fund manager, you fully appreciate. But since its inception, it's been running at plus RBA cash outcomes. Now, obviously, some years have been better than others. This year is a really good year for us. It's tracking towards about a 6.5% total return. It has incredibly low volatility, but you do not have that right tail. So if we get a 2008 moment, you don't get the big kicker.
Yep.
But then again, you don't get the left tail, hopefully. So we think that that's an interesting solution, and certainly talking to folks that are now looking at blending that a little bit, saying, I want to lift my allocations. I want high quality assets. I really want liquidity. Remembering in COVID that, we were one of the only fund managers that gave everybody liquidity. When things got weird, markets seized up, the quality of these assets is really, really important. And so, we're not arguing for 100 cents in anyone's fixed income dollar. We've never argued for that. But we certainly think that, where we look at the different subsectors of fixed income, some of them do look somewhat fully valued. Certainly sovereign debt has had a tremendous underperformance. And if we look at, index relative type outcomes that are cyclical in nature, they're really stretched in those historicals. Now, that doesn't mean that they're about to snap back, but it does mean they're stretched and they might stay stretched. But there's certainly other ways to go about this. So if you'd like more information on that dynamic alpha strategy, we'd love to talk to you about it.
And just so we're clear that we're kind of aiming for that red piece with dynamic alpha. And if you're looking at duration, we're kind of going out to the further tails. Is that right?
Yeah, absolutely. So dynamic alpha is designed to have very limited drawdown. Now, obviously, when things get really complex and move fast, when the RBA removed yield curve control in October 21, that caught everybody by surprise because we're a developed, sophisticated market. If you have an RBA policy set by the board, to change the policy, the board should vote it out. We didn't do that in this instance. So there's a bit of a process fail. And clearly the market's got hammered. Russia-Ukraine war outbreak, again, very unexpected. And, massive surge in energy, massive surge in inflation expectation. Again, we have stops. They have waterfalls in them to stop no matter what. And in those really big gappy moments, the fund drew down 40, 50 basis points. Which
and I think if we go to the next slide, Matt, we can actually demonstrate how that actually some track record there.
Yeah. So look, I'm still hand on heart a believer in duration in portfolios. Obviously, the total yields that are now available in those instruments have never been higher in our history as a fund. I don't think necessarily that we're going back to 1% interest rates, but if we stay restrictive for too long, we will have an accident of some magnitude. It just happens, sadly. And predicting that with certainty is nigh on impossible. It's the unknown unknowns that come and get you. Last year it was Silicon Valley banking. Who the hell would have thought that would be where the problem resides? So whatever that might look like going forward, there are obvious ones like commercial real estate and that type of stuff, which are already, kind of fraying at the seams. And certainly the refi on all of that, which is coming up over the next few years, gets much more complex if we stay at really high rates. Doesn't mean it can't be done, and there's a lot of money on the sidelines looking for those opportunities. This is a very different journey, and so, depending on what you're looking for, if you are, sitting in TDs and thinking that's about as good as it gets in TDs and I don't want to be locked up for a long time, this fund has, can have unlimited access to your capital on a T+2 basis. It's grinding out, TD plus returns on very low volatility. It's like a defensive alternative. It's designed absolutely to play this role. So, really low volatility. I think there's lots of offerings in the market that, run at 6 or 8 vol or whatever that might be for that type of return outcome in expectation. We think we can hit, up at those levels. As I said, we're running towards kind of 6.5 at the moment year to date. If we were to just linear run rate it, which of course is always a dangerous thing to do, but that's where we're at so far. And, we like what we're seeing. We're now getting divergence in economies and central bank policy. And so where this was, harder to read, I guess, historically is every market was moving in unison with what was happening in the major market, which was the US. And whether that was justified or not, depending on the economics, it didn't really matter. Markets were just being obedient and, the market would click its fingers and it would immediately heal next to whatever the US master was doing. There is now divergence in these economies and certainly in policy. There's a limit to how far they can diverge. So, we're already seeing, say, the European Central Bank that really want to cut rates saying, well, we can't just go it alone without the US. We do need to see some US leadership, but we can certainly start that journey. And so from what we invest in and look across this kind of global opportunity set and Australia, that gets much more interesting. And so notwithstanding that period in late 21, early 22 was difficult, the drawdown was really mild and within our expectations in totality. But generally, this has been a good news story.
Yeah, excellent. And then I might just pick up on something you said just before around, and I just get off piece, that the US obviously wanting, or everyone expecting the US to lead rate cuts. If you could just kind of flesh that out a little bit more. And obviously we've seen some countries, and I know on the chat channel we've talked about Sweden and then Argentina, for example, central banks. I know we like that one, but just to kind of give some perspective that countries have divergent policies and we can actually see people cut rather than waiting for the US.
Well, obviously, and this comes down to interest rate differentials and how it affects your currency. So If you cut your interest rates really materially and the US don't, then clearly your currency underappreciates and it becomes inflationary. So you at the margin. So there is a limitation to wanting to do that, but clearly, the domestic situations can demand that needs to occur. So we've already seen some rate cuts in peripheral jurisdictions. Argentina, I joke about because it's cut from 40% to 30% or something extraordinary. It's an interesting economy to watch at the moment if you're into, vast change, which certainly it's experiencing. But there's no question that the European Central Bank will cut interest rates in June. How much they'll do thereafter will really be somewhat dictated to by expectation in the US. All of the data in the US has been getting a lot weaker. Now, it's not absolutely bad, but markets are very focused on momentum, and the momentum has waned considerably. It was exceptional, and it's waned considerably. That doesn't mean, and at an absolute sense, it's bad or terrible, but clearly it's headed in the wrong direction. And it is bouncing around a little bit. We continue to get, for every 2 or 3 bad data prints, and they might be second or third tier data prints, then we'll get a better data print, and the argument rages on about the real state of the economy. There is our expectation is that unemployment will gradually start to rise. We're seeing that here. I do believe that can pick up a little bit of steam, as do the RBA by their own forecasts. So there will be, some policy stimulus coming at some stage. But clearly, if inflation doesn't, settle down and we enjoy that disinflationary process again, which we have enjoyed since, peak inflations, and that's got to do with the way the base effect rolls and calculates and those types of things, then it gets harder to deliver. I mean, the Fed have told us again and again they want to cut rates. They are sniper in the grass with the safety catch off. As soon as they can, they will. But with 3.4, 3.5% inflation in the United States, that is difficult to do. And then we run out of time because you don't want to be doing that right in the middle of the US presidential election. So the markets are really focused on, kind of July, September. And then if it doesn't happen by then, it can't happen until December. Whereas the other central banks being, the Bank of England, ECB, as we talked about, Bank of Canada, are very likely to have cut, in that third quarter window.
Yeah, great. Okay. And getting us back on track. So I took us off there, but just get the next slide, Matt. A really interesting chart that you and the team have put together here, just talking about, again, thinking about duration and just, exploiting the return opportunities within that. So maybe if you could just kind of walk us through the work that you've done here and why we think that, again, duration looks interesting here.
Yeah, I mean, so this is just a look at the Australian Composite Index, which is the major index which most people have in their allocation versus a Treasury only, being an Australian government only index, which is the one that we run in our duration fund. And this is just at an index level, so it's not reflective of what managers do thereafter. But you can see here that there are clear periods where the composite, which includes things like semi-governments, supranationals, and of course corporate credit, has significant outperformance, as we would expect, higher yields, but different credit qualities. And so in those periods where the markets do jackknife a little bit, there can be, and has been, material performance differentials. The issue really becomes is that once you let managers own credit, they will tend to do it in vast sums because it's a really easy way to bring yield into the portfolio. If it's a benign environment or a credit positive environment, as we've seen lately, then clearly that brings excess return as well. So it always looks like they're making lots of alpha. It's actually credit beta. And so we just wanted to highlight that clearly Treasuries have had a really vast underperformance. It's been 4 years now. There are other periods where we've seen this. I don't want to get anyone too terrified, but it was just prior to the GFC. And then you can get that, big slingshot, change in the performance of these assets as quality and liquidity really get, very well sought after. So we're just pointing that out to folks to remind them that, yes, there's been a big underperformance of sovereign bonds. The higher the quality, the worse they've done. If you look at things in global.
So go to the next slide and we've got global on there.
Same thing in global. So, things that have had EM involved, EM's done really well. And so, these relationships, they don't last forever. Now, maybe it's different this time. We say it in every cycle. It can be. I'm not going to say that it can't be. But I do believe in cycles, and I do believe at some point that, sovereigns will outperform. Giving you the absolute catalyst and the perfect timing on that is impossible to do. But we can say that, we've seen a series of things that lead us to a series of outcomes, i.e. really restrictive policy in the world isn't a good thing for these types of relationships over time. How long that time takes to generate the tension that is required to get these assets to move, again, is the source of great debate. So, we're just pointing that out, that these are index-only outcomes. Clearly, when you go and look at the risk that funds actually run when they're allowed to own these types of assets by, what is allowable in their own mandates, you tend to get a further, performance kind of differential again. And so if you are thinking about defence and liquidity, and that's important to you, and you're a little cautious on things looking forward, then you're probably interested in this. If you're not worried about that too much, put it in the waste paper basket and good luck.
Yeah, exactly. Well, that kind of ends the formal component of the presentation. And again, I asked people to ask some questions, but I've got a few that have already come through while you've been talking, Charlie. So on the duration side of the portfolio, there's just a few questions around positioning and then potential bond auctions that are coming through. And there's been someone asking a question around this green bond that's coming to market. So maybe just go to the positioning of the portfolio and then digging onto the green bond if you could.
Yeah, so we've been a little bit underweight duration over the course of this month. We're a bit overweight duration today, and we've gone a little bit early in that. We've had a big sell-off in the last 48 hours, but the reason being is we've got a really big index extensions at the end of this month. We are, as I said, we're right in the middle of our expected range, or very close to. So we don't have a particularly large skew to duration at this point. What we do have coming up for us in the very near term is this Fair Work outcome, which is released on Monday morning. That will calibrate inflation expectations here domestically. And then we've got this green bond issuance, which is slated for next week, which is an exciting development for Australia, obviously. We've issued green bonds in the semi-governments, being the state governments, but never as a federal government. And that's going to be a big syndicated issue, somewhere between $7 to $9 billion. We'll be very interested in that to bring that into our portfolios. We do think it'll be very, very well supported and sought after. So it's an exciting development, and we want to support that where we can. And obviously, we try and include ESG positive type securities in our portfolios where we can. But we do need to touch on US bond auctions because they haven't gone well this week.
Yep.
And it's very rare that you see 3 auctions in a row underperforming the way that they have. They've cleared okay, but we were asking markets for $170 billion-ish worth of capital. In a compressed week, there was a holiday in the US on Monday, and there's been obviously a big concession, and the auctions haven't gone well. Ordinarily, when we get these kind of concessions, you do expect the auctions to go well. So it was certainly my expectation last night, having had 2 weaker auctions, that the auction last night was a 7-year auction, would do better. I think it's just a combination of markets that have been a bit long duration. Obviously, the data has been, decaying, as we mentioned. It's not out and out bad, but certainly we've seen positioning start to build up. And we've also had a period of compressed volatility in bond markets, and all of a sudden you've got this big slingshot. So I do think that, there is probably a bit of position cleansing that's occurred. It's not healthy that we're having these slight tails, but these auctions are still getting well satisfied. It's just not absolutely at the clearing price on the day. As we know, what we saw from the last Fed meeting, if the Fed and the Treasury want to bring the market back to a different valuation, they can do that fairly quickly. In the last Fed meeting, the governor had every opportunity to say that we're worried about inflation and, we're not going to cut. And they didn't do that at all. They started a buyback program, which is the first time they've run that since 2006. So here we are again in somewhat manipulated markets. It's little, but as we always say in markets, there's nothing as permanent as a temporary solution. So you can expect to see more of that. They've watered down the QT program. They can continue to do that. And then the other thing which is impactful for Treasury and all fixed income at the moment is the rising nature of Japanese yields. So they've been rising quite quickly, and that's been coinciding with weakness in the yen. We did see some intervention in the yen, a few weeks back. We are getting back towards the levels where that was, heavily supported by official institutions. So, all in all, we're kind of in the middle of a range. It's easy to put, particular narrative on how we've got here or what the exact reasoning is behind that. We were talking before this started. There's no one single thing that we can identify. There hasn't been a plus 400,000, non-farm payroll print and a big drop in unemployment. It's just happened in and of itself. And so, it's just a market being a market, having a bit of a clean out, making some room to take down the supply. And we'll see where we get to next week. We've got, as I said, PCE, which is the Fed's favoured inflation number on Friday. Expectations are there that that's pretty well contained, and so can keep, the July rate cut open. But markets are, sitting, looking, saying, well, the economy's still keeping on. We don't see a series of rate cuts, even if you cut in July. And so they're just a little cautious on those elements. But yeah, and then into non-farm payroll and ISM next week. So we'll see where we land after all of that. But, the US Treasury, as we said, have still got vast expectations to borrow lots and lots of money. Both presidents seemingly will stay on that pathway. So this is something we're going to continue to have to deal with, from the Treasury sense. And you've got to remember that US Treasuries, we believe, will always clear. So if they must go to high yields to do that, it will ultimately suck capital from other parts of the global complex. And so where that comes from, it clearly has a big flow of funds impact. But I think, if that Treasury market can't clear, well, then we're talking about a vastly different world.
Yeah, and I know we were talking about this before as well, but and you mentioned it earlier in your opening comments, is just around the vol of the bond market itself. And I think we'll talk through that if we had this auction and inflation print that came through a little bit higher than expected, we probably would have seen rates sell off even more aggressively. So it's good to see and getting your thoughts on why is that? Is that because of the prevailing yields and the nominal yields, or is it because there's institutional investors that are interested in actually capturing?
I think the rate pathway, or as much as we're, umming and ahhing about when will we cut, how will that work, do we need to hike once more? We're not talking about 10 more rate hikes, and we're not talking about 10 rate cuts at this stage either. So the MOVE index, which is the volatility of the bond market, has been coming in all year. It's kind of back to more long run averages now. But because of the data dependency that we now live under, every data print sees that, inside of that range, it's actually quite volatile. So we tend to gap to one side of the range and, be that, the data's better, so the bond market sells off. And then we have a weaker data print and bond market rallies really fast. And so we're kind of busy going nowhere. So I think it's important, particularly if you're a retail investor and you don't move around too much, don't get caught in the, the fizz of what's happening in the really, really short term. The much bigger picture is yields are really elevated from where they have been historically. Whether they stay there, and that's our new continuum, well, we don't know, but clearly that has a big impact on asset valuations through time. A lot of assets that have had very high valuations have found those valuations from having very low discount rates. And so if they must be extended and expectations are in the out years that we continue to stay at very high interest rates, I think it will change asset valuations. And we are seeing that in things like commercial real estate, and they are vast revaluations when they're occurring. But, it's early in that journey and so we'll have to wait and see where that all lands. But, the bigger picture is that, inflation has been coming down hard from 8s, 9s, 10s in Europe at one stage to 2s and 3s. We don't want to see it go back to 4s, certainly, but it's bouncing around and it's being annoying. Why just get back to where you need to be? Well, it's not quite working like that. Services side of the economy is still sticky. But, a lot of things, global supply is now essentially normalized. Global energy, as much as we saw a rally around, tension in the Middle East and those types of things, it's dissipated. And if we look at things like the price of gasoline in the US, it's come off materially. How does that work through driving holiday season coming up? Well, we'll wait and see. But there are not things that are slingshot higher in the inflation series. And so we're bouncing around. It's still our expectation that with a tighter economy, as we expect, that there is moderation in that, and we get to a place where we can, deliver gentle rate cuts. What happens thereafter, we'll wait and see. It really depends on how the credit complex works and whether it's got enough macro momentum to be self-sustained. If we get a stall in that macro, then, it's like a plane falling out of the sky. But at the moment we don't have that. So we've got to see how that, kind of develops over the back part of this year.
Yeah, and I think it's interesting that, a lot of assets are still at all-time highs. We've experienced our, retracement, and now the product looks interesting just from holding it as a yield perspective. But there's other assets that haven't, had this experience of resetting yet. So that's where I think the opportunity lies as well. We've got time for maybe one or two more questions, so please send them through. But Charlie, we've had just someone write back. They'd like to go back through the bell curve analysis just focusing on the duration outcome. So, Matt, if we go back to slide 9, if we put that back up and just kind of walk through the bell curve analysis, it'd be appreciated. Where we're just looking at what from the middle, where are you expecting the returns to kind of sit?
Yeah, so sorry, a lot of folks that we've presented to have seen this for a number of years.
Yep.
On the bottom right-hand side, this is our scenario analysis that looks at index-only outcomes. It's, again, we can't forecast fund returns, but I can tell you that if the equity market goes down 10%, then the return is down 10%, right? So this is what we're looking at in the bond market to say, with the assumptions that the central bank will fight inflation or not fight inflation, i.e., if we go to the left side of a geopolitical shock, say scenario 1, then inflation is expected to be higher and the RBA will continue to raise interest rates. And so what that does is it flattens the bond curve. And to the right-hand side, less inflation, and clearly, the RBA can start cutting interest rates and therefore the curve steepens. So actually the long end doesn't perform as much as the short end would do. I don't want to get too technical with that. That is the only assumption in this, and it is uniform. So hopefully if you've got different thinking about that, you can dive in between the expected index return outcomes and say, well, I think I'd be in here somewhere under this type of scenario. So they're just 5 scenarios, with the middle scenario being absolutely where the market was at the end of April, which is actually quite close to where we are today. Clearly, we can go to higher for longer. And what we're trying to illustrate here is that because there's a lot of income available now, even if bond yields sell off by a reasonable amount, 50 basis points, then there is still total return. But as I said earlier, you would have done better in cash. If we go to the right-hand side and bonds rally a little bit, well, then clearly you're much better off in bonds, and that'll severely outperform. And it's very likely that cash rates will be coming down. So your reset values, your opportunity to reinvest those term deposits as they're rolling, are likely moving away from you. So it really comes down to what your particular needs are and how this works in combination with your portfolio. What risks are you trying to balance against? And if you decide that you need these types of solutions. The left-hand chart is obviously just a normal standard deviation curve, which we've all studied back at high school or at university. To say that, everything is possible, of course. And so we can't predict this with any kind of certainty. Clearly, we think that there is, a mid to right-hand probably, bias to the way things will play over the next 12 or 18 months. But, who knows? Well, we certainly know that there's very unexpected things have occurred over the last little while, and they can continue to occur. But if you believe in cycles as we do, then the cycle will complete itself at some stage. And it's likely we'll go into a rate cutting cycle, and bonds tend to do very well in that environment.
Excellent. And I've got one more question. It's from Brett. So bear with me. Charlie, the reverse repo has been falling a lot in the US. The expectation being that bond issuance increases under this scenario. Where do you think this issuance will be placed? And in the, I think, global bond portfolio, are we short or at the long end of the curve?
We are short the long end of the Treasury curve, and we are overweight the long end of the Japanese curve. So, Brett, I might take it offline with you because it does get a bit technical. As I said, with Treasury supply, look, it will find a home. If it needs to find a home domestically, and it's certainly our expectation that it does, it's not a good location to go and build a US Treasury portfolio if you live in Japan or in Europe or in Australia. The currency is not appealing. It's not a good place to be unhedged. If you hedge the currency, it's very unattractive. So the problem for the Treasury complex is it's losing sponsorship. There's no more petrodollar buyers. China's not buying, Russia's not buying, Saudi Arabia is not buying. So it needs to be internally funded. Now, of course, it can do that. It's got huge amounts of capital internally. So that's absolutely possible. But at the margin, we're just losing those international support networks that have been, a big beneficiary for the US over time. I think at some stage there is a story around the strength of the US dollar. And that's a different story. It comes down to the sustainable pathway of living under perpetual deficit. If you're running a 5% deficit and growing at 5%, well, then that's fine. But at some stage, it looks like that growth will, chug out, and we're seeing that in the private sector. And yet, seemingly, from a political viewpoint, there is great motivation to continue to keep spending, to win votes, to regain power. So we've got to assume that certainly in the near term, that doesn't change. And what Trump might deliver should he be elected, who knows?
Who knows?
So he's not exactly a guy that wants to repair the balance sheet. We don't think. He likes to borrow money and lever up. So the US is, yes, definitely something that, we've got to think about deeply. As that leads other markets, that's important. But as we said, there is that divergence between economic outcomes. And in the end, the US needs global customers. So, if everybody else goes into recession, of course, the US, as everybody else sneezes, they're going to catch a cold. So I think that's interesting, but I'm very happy to get into the detail offline if you'd like, but
easy. All right. Well, we've hit up time. So again, thank you everyone for making time. There's a contact page with some of my colleagues. So if you feel that you've got questions, please do reach out. Charlie, really appreciate you taking time to spend with us today. So again, we'll send a copy of this and the recording and the slides to everyone that's on the call. But again, have a good day and thank you so much.
Thank you.